Hey, welcome everyone. Thank you so much for joining the Canadian Multicultural L.E.A.D lead organization. We have a special presentation for you this evening in collaboration with the Credit Counseling Society, where we're presenting Borrowing 101. And today is August 19th. We are scheduled from 6 to 7:30. So without further ado, we're going to move forward. I'm going to introduce the lead organization, and then we'll introduce to you our special guest speaker today, Philip Wilkins. Right. So welcome to our amazing organization, the LEAD org. For those of you who are not familiar yet with what the LEAD org does, the LEAD org is the Canadian Multicultural Lead Org for mentoring and training. We are a registered charity, and our aim is to help youth and adults turn challenges into opportunities through empowering them to build key skills that are founded on 4 principles: leadership, empowerment, achievement, and determination. Since inception in 2007, the LEAD program has provided one-on-one mentorship to over 300 students across the Greater Toronto Area. And our mission statement is: we give individuals from youth to seniors the support to develop strategies and tools to create their own success stories. And Olami and I, we really enjoy what we do, helping provide tools, including financial literacy, to all the amazing members of our community. So now I'm going to pass it over to Olamide, who will introduce our guest speaker. But before that, she will do our land acknowledgement.
Yes, thank you, Valerie. My name is Olamide, and I am one of the program coordinators here with Valerie, and I will just get started with the land acknowledgement. As treaties people on Turtle Island, we are obligated to uphold treaties made from a long time ago. Where I am situated, I would like to acknowledge the traditional territories of the Mississaugas of Scugog Island First Nation, the Mississauga peoples, and the treaty territory of the Chippewas of Georgina Island First Nation. I also want to thank the First Peoples for the ongoing teaching of how we are to learn on the land and from the land in partnership with each other, the animals, and the plants. Next, I'll be introducing our amazing speaker for tonight, Philip Wilkins. So Philip is an educator, a certified educator and counselor with the Credit Counseling Society. He also has a life career in the financial services industry. He is a father of 4 boys. He is responsible for the Ontario and Eastern Canada region of the Credit Counseling Society, and his passion is to ensure all Canadians have the correct information to make the personal financial decisions. Welcome, Philip.
Thank you very much. Thank you very much, lady. LMD and Valerie, ladies, appreciate it. Everybody, now you see my picture. If you heard me speak before, yeah, I've said the same thing. This is not an episode of Hoarders you're watching. This is my downstairs office. I will be shutting it off while we present, so you don't have to see this, okay? Anyways, I thought I had a nice little backdrop for you, but my cats got at it. They dragged it down a little bit, so I couldn't get it unfolded properly. Anyways, welcome. And we do have a special presentation. I'm going to get my screen share going here so that you can see it. I can share now, I think, can I? All right. And I want to get this.
Yeah.
We're doing okay. Should be that one right there. Okay. Can you see that one now? Credit Counseling presents Borrowing 101.
Yes, I can.
You got it? Good. Okay. There we go. Well, again, welcome everybody. Credit Counseling Society. We are also a not-for-profit organization, and we are under charitable status. You see our battle cry: we help, we educate, we give hope. This is a real passion for me. I've been doing the mainstream banking since my whole career, and I've been a not-for-profit now for just about 10 years. And I'm glad I made the turn. It's like I finally met my niche here where I want to be. And there's a passion of mine, raising 4 boys, and I have still 2 at home. It's important for us, whether we're just getting started off in life, whether we're new Canadians, or we're getting ready to, take our final assignments, make sure that we have the correct information at hand to make some very important decisions about ourselves. And with that in mind, my background is not just banking. It's also even more specifically to people's finances, yes, of course, but lending and collecting and that type of thing. Very, very intimate with it. This for me is a conversation that I love having, As we do it, I'm going to ask this. If you have a question, please you go ahead, put it in the chat, okay? And we will talk about it. Don't worry. We have an hour and a half to get through this, so we have lots of time to entertain questions when we're done as well. So no, don't panic. And I'll further say, the ladies have my contact information, and should you have any questions or anything else that you wish to discuss, do not hesitate. Reach out. If you need to get more information, we provide it, of course, for free for our clients. And of course, the ladies are our clients, so are you, all the attendees. And also, if you would, if you just keep your microphones, you have to stay on mute so that we don't have any background noise, okay? That does sometimes interfere. We had one earlier today, and it was a little distracting. We got it sorted out, but it took a bit of time. Today, 101, borrowing 101, we're going to talk about it. It's an area that is near and dear to my heart. We do continue to have a mishmash of information always seems to be presented to us on this topic matter. And I want to make sure that we talk about the things you need to hear about, okay? Let me get this rolling for us. If you may have seen the screen before. Why we present this particular template is, again, it's just to show that, I mean, life happens, right? And we understand that piece. And in our business, in my area, excuse me, there are 7 big reasons why things can go sideways with our own personal finances. I'm sure none of us have issues with the 7 on the board. They seem pretty straight up, right? They absolutely are. And when it comes right down to it, like, these things don't discriminate. They don't care how tall we are. Stuff just happens. Right? So we want to prepare to that. There, hope my screen shows properly again. Now, what we're going to talk about tonight, what I want you to hear from me, from my lips, is I want you to know who creditors are and what they're looking for. When you're out there looking for credit, you need to get something. What is it they really are after? What are they digging for? You've heard the term credit scores. We're going to chat about that as well. I want to make sure that little piece of information is clear. I don't want you walking away with, because our advertisement on this matter is widespread. I see some things that are confusing. Let's just break it down simple to talk about what it really is. And I also want to touch on the types of loans out there, because we find it's another source of confusion for our people we speak with, or who we counsel. And if it comes right down to it, just give little bits of reading of their files. Even they don't understand what they're staring at. What does it mean financing? We're going to discuss that so that you will know the difference between, for example, a secured and unsecured. Like, truly, you may know this. If it's redundant, I apologize, but it's an important piece to go over. So, what is financing? Just a couple preliminary pieces to put in front of us so that we're all on the same page. Really, what in terms of just a definition, I call it a general finance definition. It's the act of obtaining money from an outside source to purchase a good or service with interest. That's financing, because it's not for free, right? We have to pay a price. So that's how they make their money. Now, sure, I'll lend you $1,000, but I'm going to charge you 10, 15, or 20%. So when we're all said and done, at least I'll make something for giving me my money, because I can't use it. Simply put, that's what financing is. All right. That's good, right? But really, why do we do it? What do we finance? What's the reason for it? And again, I'm hoping that even our discussion right now will keep us in the arena of, it's normally associated with a purchase that is just too large to pay for cash out of our pocket. And I say this with tongue in cheek, and I mean this nicely, and feel free to smile or have a giggle, but we know there's not a lot of us that can just go and buy a house and write a check for it. Or for that matter, even a car, right? It's too large a purchase. So this is where the financing pieces can be extremely helpful. It helps us get into these particular, or get with these items. And in other words, we don't have to rent, we can buy now, or we can get our car and we don't have to wait forever and ever to save for it. Now, what we want to be careful of is, we see things like when a deal is just too good to pass up. It may be a good thing, it may not be. You want to be careful there, because it can be something like, maybe you are buying a car, for example, and you are looking for that Honda Civic, and it just so happens that, you know what, you're in the market, already been looking for them, done a little research, and then one comes up that actually seems a couple $1,000s cheaper. Yeah, you know what? You don't have the cash saved right now. You're trying to. It might not be a bad idea to be able to obtain it now. Maybe, right? But we want to be careful, right? We say if we can't afford it, but we want to buy it anyways, we tend to do that. That's not. We do tend to have to counsel, and we see that issues can come up with our own personal finances if we can't really afford something. You know what it comes down to? Isn't it about the wants versus the needs again? This is where we want to be careful. The credit piece is we find far too often we got the wants and the credit is going after the wants, but we're starting to forego the needs. Right? So we have to use our own course, a good adult judgment on this one. And I just go to the last one. A lot of us do borrow to improve our credit. We may have none, or we've had some credit issues. And if we can get a piece of credit and keep it up to date, it'll help improve our score. It's true, it can, but we're going to talk about that a little bit more later on, okay? So let's just go a little bit deeper. Why do we finance? Okay, whatever, but what are they looking for? I want to get into this. Let's talk about the creditors. First things first. What are they looking for? I need to go buy a house or a car. Well, what they look for, we call it the 5 C's. Then they look at your credit score, then the debt ratios. All right. Let's break these down so you understand what they are. And if you've seen them before, fantastic. Maybe I can reiterate some information for you. But right now, let's look at what this means. And we've actually, it used to just be the 3 C's of credit, by the way, but we call it the 5 C's. First of all, they look at your character, and your character it's not if you're a great joke teller. That's not what we're looking for, or they're looking for. They're looking for who you are. Basically, what's your position? How old are you? Do you have a job? Where do you live? Do you own or do you rent? And that has a little layover to another category. And they'll even look at, do you have to support a family? This is what they're piecing together. Then they're also going to look at, what does your credit history look like? Because attached to who we are is how we do our personal business. And they will look at things that show up on your credit report. For example, your cell phones. If you have a cell phone on a plan, it will show up on your credit file. Any credit card that you have, any loan, even the leases will show up on your credit file if you have any. So that speaks to who you are. Who are you? What are your personal circumstances? And how are you doing with your obligations right now? The second piece is capacity. And that, just as it says, they're just making sure that if you're looking to get a loan, that the new payment that is being proposed is in line with your budget. In other words, all things taking into consideration, can you afford the new payment? And of course, if you're buying a house, they trade your rent for payment for a mortgage payment, or from one house to the next, of course, they just take the one payment in consideration. They want to make sure you have the room to make those payments. Collateral just speaks to what they have attached to that, which is, do we have any asset? Do we have any security to the loan? Buy a car, they hold the car until it's paid off. What's the downside of that is, well, if you stop making your payments or you can't pay, they can take it back and sell it and then look for the rest of the money later on. But they have the right to take it back to help what they call mitigate their loss, okay? Which lessen the loss. That's what collateral is. Of course, in a mortgage, they have your house. Conditions, what they also look at is what's going on around you in your community. Like, they're more looking at the economic community. Are you in a job that seems relatively stable? I don't know if you remember this. We're taking back several years ago now. The .com industry. Remember, it just blew up. It just went bananas. People were becoming millionaires at seemingly overnight, and then almost as fast, it started to decline, and people were going bust, seemingly overnight again after a little while into this. Well, lenders like to be on the lookout for that bust and boom. If it's a little bit unstable, the conditions portion of their analysis, if it comes up weak, they'll be very cautious. That's what they're looking for. Are you yourself in a job in which it has a good future, or is it a kind of a dying endeavor? Like if you're working in a mine that was closing down, it's probably not a good idea to look for any loans at that point in time. And they look at capital. Now, capital just is kind of a commentary as to how you are in terms of accumulating assets. Now, you may not have a whole lot, but you're still in good shape. So not having any capital does not necessarily preclude you or stop you from getting a loan. What it might do, though, because if everything else matches, if you got good character and you can make the payments in terms of your capacity, and you're in a decent job, looking good for the future, you're still a good candidate to get what you need, of course. Capital just may speak to if somebody's been in an area for a period of time, and they may wonder, well, what have you been doing with your money? Oh, I've got some several $1,000s saved up in the account, or I've got an investment someplace, that type of thing. It may speak to what you've been doing in the past with some excess cash flow, if you will. If you have some, it definitely helps. It does. So that's the first piece they look at. Okay, that's the 5 C's to see if from their risk analysis point of view that they can continue with the approval of a loan. But it doesn't stop there, right? Because as they're looking at your character, what they're going to look at is your credit file. And you've heard this term, your credit score. I never like anybody to freak about that, but they do have a look at it to see where you're placed. And in terms of your credit score, that's from the Equifax or TransUnion. Those are those two businesses that they just hold their information. It's who the banks and the lenders report to. And it's like a storehouse, it's like a library of our financial business so that the lenders, that after paying a fee and with our permission, can look at how we've been doing in general. Now, if you want to get a feel for where it should be, let me tell you this. And again, this is a little sub note. This is the real McCoy. First of all, scores a range, as we say. You have zero actually for a little while, but non-existent. But normally you'll see low end goes about 300, the high end is 900. Bear in mind, there's no such thing as a perfect score. Nobody has 900. If somebody says they do, they're lying. No, it's not. It's because it's not possible. Okay, and you're not supposed to be able to get 900, but they have to give the range. Obviously, at this point, knowing that the lower your score, the worse it is, the higher your score, the better it is. When there's this formula or formulae, I guess, in the background that they run, there's a lot to it. And we're not to know all the bits and pieces of it. They got logarithms running in there that take all of our circumstances. They run a bit of analysis to come up with the score for us. I can tell you this, that there's some common sense things that will drive it. Okay, so if you want to know the range, first of all, if you were looking at your credit score and if you had your credit report, you say, okay, great, Phil, I got it, I got my hand. Where should I be? Well, I can tell you, if you're at 600, other than payday lenders, okay, take them off the table for a second. I don't want to talk about these no credit check stuff. That's just a different ball of wax. I will talk about them later. We're talking about normal lenders now. Okay, when you're 600 or more, they'll look at you. It'll be pretty tough to get a loan at that range. A 600 means, let's just use a car loan for an example. Okay, we can use that as our pivotal parameter. You're trying to buy a car for $10,000. We're going to assume it's brand new. Okay, I know, it's a heck of a deal. Tell me where that is, Phil. Yeah, right. Anyways, so and you're applying for it and you score 600. The lender may say, all right, I see you. You're not scoring real high just yet, but you want $10,000, huh? All right, so here's what: either get a co-signer, somebody to sign with you to help back up so they feel better about it, or maybe we need you to put $3,000 or $4,000 down. We'll loan you $6,000, but you got to come up with the rest. You know what that does? It just means if something goes wrong right away at the loan, that they're more likely to be able to sell the car and get out of it without any difficulty. That's what happens when you score that low. Versus now, when you hit 650 to 700, now they're starting to say, all right, I see it. Yes, you're scoring better, and you want this loan. Maybe we just need a little bit of down payment. Just give us $2,000. We don't need a cosigner now. 700 to 750, that's where you start hitting the sweet spot. Okay, 7 to 750. 700 means they see your credit score, you may just be approved as is. And 750 range, now they're going to say, well, yeah, you know what? We're showing people at 8%, but you qualify for a 6% loan. So as your credit score increases, you can also save some money because you will qualify from a lender's perspective for better rates and better deals. Okay. Now, what drives this? I mean, there's a score. How can you keep your eye on it? Well, how are they peeking at this behind the scenes? Well, this little graph is going to show you how this thing kind of weighs. Now, again, remember the math behind the scenes is running these percentages, but you can see the big three. They stare you right in the face. So if you want to know how to get your credit off on the right foot, you want to know how to get it back on track. Number one, the big blue, right? There it is, payment history. If you have your accounts and you're back on track, you've got your cell phone back on track, you're paying it just great, you've got maybe one other piece of credit, keep it up to date because 35% of your credit score depends on that being like that, being up to date. Okay. Now, interesting, look at red, number two, amount owed. 30% of your score depends on how much you owe. Again, the theory is that the more you owe, the riskier it can be. And again, quick analysis, right? $2,000 limits on credit cards. You've got one. It's that limit. Something happens. You can't go to work. You're off for a little bit. The minimum payment on that is probably going to be somewhere around $50 or $60 or something a month. it's more likely you can make that payment and you'll be able to maintain it until you get back to work versus having 5 credit cards, because then, it's $10,000. And if they're all at maximum, that's difficult. Now you're talking a few $100s every month to pay. Something's got to give. Right? That's what they do. That's back. I'm simplifying it, of course, but that's the theory. Right? So little tidbit number 2 here is, you see, you don't need to carry a bunch of credit to get a good credit score. You just got to keep what you have in good shape. As a matter of fact, on your credit card, I'll give you the short and dirty on the big 3 for a credit card here right now. If you want to be able to maximize your score, 3 things with a credit card. Number 1, keep it up to date, right? Big blue, no brainer. Okay. Number 2, what you want to make sure is that you keep it under limit. What we suggest, like this is the amount owed thing, what we suggest is keeping it about 40 to 50% to the limit maximum if you can. Going over once in a while is okay, but if you can keep it down to that amount, you look less risky on paper. So hence your score will increase. And number 3, if you can keep those 2 in check, then maybe you'll be able to pay your credit card off every month. And if you can, that's the big 3 for keeping your credit score, helping your credit score rather build more quickly and to max. Right now, before we leave this, you see number 3, the green peas, length of credit history. See, the other thing here, what we're looking at is credit is also a timed element. And the longer that we can show that we're on side or paying well, the more the creditors like it, the better our score will be. So here's the example. You're faced with a dilemma. You do have a credit card and you've got one of those deals. Take our credit card, transfer the balance over, and we're going to give you 0% interest for 6 months. Like, read the fine print, right, everybody? You got to read it. You normally, there's transfer fees involved in this as well, so it's not as big a deal as they let on it is. But you get to start and you say, okay, that's not a bad idea. Why don't I take advantage of a better interest rate? And you know what? It can be to your financial advantage to do that. But is it a good idea for your overall credit picture? Well, here's the thing. If you just had one card and you got to the second one, you said, got a brand new card, and this one's offering me a lower rate across the board, and you end up saying, I'm going to take Phil's advice. I'm just going to keep one. If you cancel the old one and keep the new one, what's the issue? The issue is that the new one has no history. Therefore, it's got nothing back to fall on. Therefore, you look like a brand new credit individual. Whereas if you kept the older one open and maybe just used it, you've got good history with them, it will stay on your file. Right? So just be cautious. If anybody's going through that transition, you're going through that particular thought right now, you've got a situation at hand where you're thinking about it. If you need to discuss it, look it up. You can certainly Google it, and we're more than happy to talk about it as well, just to make sure that you've got the right information before you make that choice. Okay. All right. We got that, right? Don't beat that down anymore. We get it, Phil. Credit score. But what else are these guys looking at? Well, we talked about your payments, your capacity. They want to make sure that you'll hear this term. They call debt service ratios. Don't let it freak you out. Simply means is that what are your payments to your income? What's the comparison between the two of them? And they'll throw things at you. First of all the lenders want to make sure that if they put your monthly housing costs and the debt together, what does that normally look at? 40%. Not more than 40% of your income can be used up for maintaining monthly and debt payments. Right? That's the standard. That's the norm. So if you do a quick calculation, you're applying for something, you say, oh, I take my whatever it's my mortgage or rent payment and add on my credit card payment, maybe whatever line of credit. If you're over 40%, they may allow to 42 even. It's going to be kind of, we call it nip and tuck. It's going to be close whether you get approved or not. And of course, they're going to make sure you got your total gross family income in there, right? They use the gross family because it takes, and if you got 2 incomes in the family, it can take 2 to operate your house, of course, and they know that. Just bear that in mind. And okay, tidbit number 3 as a lender, and you got to kind of weigh this to how your life is right now. So just take this with a kind of a grain of salt. Was if you can operate, if you do have 2 incomes coming in, and you can operate your housing and your debt costs on one salary, then you're in a what we call a fairly decent financial position, because if something happens, at least if one income gets reduced or eliminated, you have the opportunity to at least be able to survive through a bad situation, right? That's what they're looking for. So bear that in mind. Okay, right, please remember to mute everybody, okay? If you would, please, we appreciate that. Now, there's when they throw out what kinds of, they have to assess what kind of loans they're going to give you. And here in Canada, we know they look at, there's basically two types. They call it secured and unsecured. So for our borrowing 101, all we want to make sure that we put on the table for you is that there's either a loan that they can take something back from you again, or a loan they give you because they trust you. We call it like a signature loan or a note loan. You sign for it. Essentially, that's what a credit card is. And if something goes wrong, they're taking a chance. They got nothing to pull back on. Okay, that's what it means. Okay. What's the biggest examples? Well, you get a car loan, you know that they hold that for security until the loan's paid off. In other words, they hold on to it. They don't until it's paid off. If something goes sideways, when I say sideways, it means you can't pay it. You know, you end up going behind. Then they have the right to come back and take it. They can do the same with a house as well, of course, which can be, it's an awful process to go through. And believe me, lenders don't want your houses back. They don't. It's a big cost for them to get them back and to put them back in the market. And they may have to go in and do some work to it. And sometimes they take, of course, houses that are bad shape and they got fixed doors and things, and it's a cost to them. So they're not the experts. They have to hire people to do it to get that done. Now, what we have to be careful of, and I think I bring this up later on the presentation, is that when you're thinking about what kind of loan to get, all right, the amount will dictate that. Pretty common sense, right? Absolutely. A mortgage, yeah, it can be $2, $3, $6, $8 million, but the lender's holding on to the house, so they've got something fairly substantial to offset that. Then they feel a bit more comfortable, like the car. Even cars depreciate, but at least they get something they can take back. Right? Now, also note that when you talk about unsecured lending versus secured, so the unsecured, like credit cards, and dare I say, I'm going to bite my tongue here, you know, payday lenders, you know, the rates are higher because they don't have anything to hold on to. They see it as more risky. So they're going to give you a little higher rate for the risk that they take. Hopefully you pay it off in time, and they'll make a little money on it, and their money's safe. Okay, that's what they want. Now, we just talked about installment loans, and very often what happens, if I go back here, watch this. Secured financing, the best rates you can get as a rule. Okay, it can go between, it does it from 2 to 20% really, because they're secured. It can be a mortgage, it can be a car loan. Unsecured are Visas and MasterCards. They can be lines of credit too, right? You've seen them, where the rates are going to be the next level up. They'll go usually from about 8 or 10 to 30%. That's usually what that means. Okay. Now, I flipped this installment loans because they say, oh, Phil, come on, like what is this? An installment loan simply means that it's a loan that is governed by a set of timelines, and that's it. You see, if anybody has a line of credit, you know what operates. They give you a limit, and you just keep paying as long as you keep it under the limit, up to date. You can borrow up to the limit of it. An installment loan it's a one-time approval, and I'll go back and use the car loan. You need the 10 grand, they approve you for 4 years, and the same payment, the same interest rate, same time of the month, all the time. That's what installment loans means. They're, from a perspective of a lender, these ones are easier to manage because we don't have to guess. Everything's put down on paper for us, as opposed to unsecured. I mean, you're expected as the consumer, of course, to be able to manage your unsecured credit, like your lines of credit and credit cards, on your own. Keep them up to date. They'll tell you when the payments due. It's up to us to pay it on that when it's expected. Keep it under limit. We know what the limit is. It's our job. It's our responsibility to keep it under the limit. Otherwise, if we go over, they can start, first of all, refusing purchases, and it may even lead them to shutting those particular pieces of credit down. You know, so that's the other thing. Now, here's tidbit number 4 for you. On your credit file, those revolving loans, they call the credit cards and credit lines of credit. If you manage those well, they will actually allow your credit score to grow more than just an installment loan. Like, they're just still good. It's because they're self-managed. Okay? That's a little piece in the background that we don't always see, right? They're self-managed. If you can handle those credit cards and lines of credit, then they figure that you are a less risky individual. How's that? All right. Now, we were having a great chat here earlier. Be careful and be cautious of things people want to put on top of loans. Valerie and I are talking about some add-ons. If you remember, Valerie, about going on credit cards, they offer you insurance protections. You get into these debts, just go in with both eyes wide open. Because a sub point number 5 for me is that while it's good to have protection, make sure it's the protection that you need. And normally insurance companies provide it. And if you've seen them before, like for example, insurance companies will insure a car loan. The car loan means, well, what happens if I get hurt? Well, we have some sickness health on that, called disability coverage. Oh, cool. What does it cost? Yeah, good question, because that's usually the bigger one. That $200 a month payment may go to $275 just because of that coverage. And it may want it, but just be forewarned, that's it may go. They also offer life insurance on it. They even offer loss of employment insurance. Just make sure you cover the costs off and ask some questions. I can tell you this, that as much as they'll offer it to you right there, while you're getting the loan, if you have an outside insurance policy already, ask your agent what they can provide. 2 reasons. One, normally they can probably give you the same types of coverages for less money. And B, as a rule, like what I'm talking about here, installment loans, they call that creditor insurance. It's just for the loan. Outside, be better price, same type of coverage, but it's better overall coverage because it's for you. It's not just specific to that loan. Okay? But it's worth the question, it's worth the phone call, it's worth the time. All right. Now, are you out there? Like, what other things should we be cautious about in terms of borrowing? Well, back some time ago when they were discovering, that taking back many years now, inflation is driving up the price of things and our income wasn't matching it. So those of us in the finance world, we knew that the banks had to make some adjustments to what they're offering so that people could afford these like skyrocketing prices for cars, etc. Well, they stretch the loans out, but one time 2 years was all you ever needed. Now they're almost giving you loans for 10 years on a car. I think you get a loan for 8 years, you might as well, just, I guess, wedlock. It's what it sounds like. Here's the deal. Leasing has been around for a long period of time for us. Leasing was a commercial product they used because of the leasing, cement trucks, equipment. Well, they parlayed that into the private sector, the down to where we can use it, and hence the leasing product you see today. And it's certainly been used well, and it's revolutionized the game in terms of buying for sure. And it's got good sides and bad sides to it, right? But it does mean that maybe you get it as something you could before. Right? Now, remember, the lease, you don't own it, of course. You're just really renting it. That's what you're doing. And I mean, once you pay it out, if you have to go pay it off, you can own the vehicle, but you got to buy it out because they'll give you, because when you lease it, you're only renting what half of it or so for the first 4 years. So it can help, but I'm sure you've heard this before. You just want to make sure it suits you. Right? The upside for leasing, well, they say it best sometimes in the ads, right? Leasing can get you more dollar for your bang, more bang for your buck, right? You can buy the new vehicle that you wanted because the payments now come down where it makes sense for you. Yeah, they'll defer tax. You only pay taxes on the payment. You don't pay all the taxes up front, right? And quite frankly, if you are a business person, especially you're an entrepreneur, there are ways that you can, of course, write off the vehicle. It'll be able to, what do you call it? Devalue it. No, I'm talking, write it down. It has advantages under those circumstances. Now, like anything else, there's a downside too, right? Because remember, there's certain things in the contract you must be aware of. What are the kilometer restrictions? If you drive high kilometers, well, leasing's probably not for you. You still stick by the maintenance. If you don't, you can avoid the contract, the leasing contract. You got to buy it out. Now, the insurance might be a tad higher, sure. When you go to trade, there's no asset to it. They can do all the fancy talk they want with it. You don't have any asset. You're simply giving the car back again. So again, just make sure that if the leasing works for you, that's great. If it doesn't, you may not want to get into it. It can actually cost you money in the end. And something else that you realize too, that once you get into the leasing world, unless you can switch out quickly, you're into it's called the perpetual payment world, because it's a series of payments. The payments don't go away until you actually buy it out. Okay. Now, further to that, making sure you know that when you're buying the loans, the borrowing 101 will also let you know that there's different rates for new versus used cars as well. Now, while you're looking right now at the advantages for buying it or a new versus used car, the bottom line for the borrowing 101 discussion is that a new car a lender will offer you a preferred rate. Of course, number one, better security. Number two, usually you're borrowing, the person applying has got that really good profile, right? Remember the 5 C's? They're all in line right now, right? They're all lined, it's beautiful. So, and they're prepared to say, all right, and we want you in more car. We want you with us longer. You heard that before? You get to stay with us longer now. We'll give you lower rates. Heck, sometimes they'll give you 0% for a while. And if you can take advantage of a 0% deal, I say go ahead. If you're in that marketplace, absolutely. But that's one of the advantages of being in the new market. Now, used, of course, and now lately they're talking about the value of used cars being at an all-time high. I don't think it's going to stay like that. I don't think it can. The car people want you to think that, but I don't think it can. Still, in the end, you can still get a used car, some good deals. Bear in mind that if you have to finance them, generally speaking, the rates on a used car will be a little higher. Shorter terms, a little higher rate to it because of the fact that they don't make a lot of money on them. I'm talking the lender's perspective now. So they'll want to charge a little more. Okay. Really not much more than that. Okay. Now, we always say, beware of a few things as well. Rolled over loans, that just simply means that's like the perpetual consolidation loan. That means if you get the car and you buy it for 10 grand and you're down to $4,000 left, you want a new car. And they'll say, don't worry about it. Sure, we'll just roll it over to the new one. Well, now your new $10,000 loan becomes $14,000 and so on and so on. Okay, just beware of that. Hopefully, somewhere down the line, you'll be able to see the light in the tunnel. You know that I've got my mindset. After whatever it is, I got 12 more months, I'm going to pay off my vehicle. Hopefully we can get there. And if they tried long amortization, just means stretching out the loan as long as you possibly can to make sure that you keep the payments as low as possible to keep you in the car. It can be daunting. Anybody out there has done this, you know exactly what I mean. You're trying to stay in a car 5 years is a long time as it is. Oh boy, what about trying 6, 7, 8 years? It depends on the vehicle. You know, if the vehicle tends to, after 3 or 4 years, start rattling and roaring on you, I hope that the loan's almost done because it can be awful trying to fix a car that's out of warranty and still have payments on it. Okay, and there are, and feel free, get online, check out the lemon reports. There's a couple manufacturers that have some cars that can be great buys, and in the short term, they get you in a decent car. But I mean, I can think of 2 of them right now that in a 36 and 48 months, literally the dashboards start to rattle and creak and transmissions start to slip. So you just want to do yourself a big favor, check out the lemon reports, okay? And I think it's just lemonreport.ca as well, okay? Now, just talk mortgages and houses for a second. What's the ins and outs of the mortgage? It's a secure loan. Absolutely it is. Of course it is. Where do they go? Well, they offer up to 25 years. Their actual places will show you 30 years you can go to, but most will stay to 25 years. 30 is more of an exception basis. They will always want 5% down minimum. And you know that means that if anything less than 20% down, it goes through what they call CMHC, right? Canada Mortgage and Housing Corporation. Basically, it's a Canadian corporation, a government corporation that backs up the bank in case something happens and they got to repo a house and they lose money on it. Then the CMHC will come in and pay the bank the difference that they lose. Okay, it's a premium attached to it. Who pays that? The mortgage does. They lend it to you. So if you've got less than 20%, they'll lend you the $3,000, $4,000, sometimes $5,000 premium to pay that particular fee. The stress tests these days, we're at 5.25%. It's just to see if something happens and you have to renew your mortgage. You're midstream, you're already committed in, and they want to make sure that if something does happen, the rates go up, that your personal financial situation can sustain a rate increase. Take you back to, I'm sorry, I got these little sidebar stories. I hope I'm not boring you, because when you do this as long as I have, they're there. I can take you back to the mid 80s. Early mid 80s when I was up in Timmins, and the rates from, and actually was, I believe it was Mr. Justin Trudeau's father was in power at that time. But anyway, inflation started to hit and the rates went up, and they were hitting from the mid 5, 6, and 7s, which people were doing because the mortgage amounts back then weren't as high, of course. And they're going to 14, 15, 18%. And in the first or second month when I was working at my new job, I had 3 families come in and just give the keys back to their house. And they literally just moved out, said, sorry, we can't afford it, we're done. Yeah, heart-wrenching and gut-wrenching, absolutely was. But that's the type of thing they're trying to protect against. Now that's an extreme, of course, that much of a jump. I wouldn't foresee that ever happening again. But again, we never say never, right? Just in case. Okay. So anyways, the stress test, remember, it's there for a reason. We must abide by it for the next little while. When you're borrowing money, what do they expect? What do they accept? Well, down payment has to come literally from equity. It's not supposed to be borrowed money because theoretically, borrowed money has a payment attached to it. And that can't be the case. They don't want anything else attached to the house, right? So you can come from your savings. It can come because you sold a house and you've got more equity now. You can withdraw it from your RRSP. It can be gifted to you as well, as long as it's a pure gift from what your family or friend, and inheritance, that type of thing. But it has to be accompanied with an explanation that there's no repayment expectation attached to it. That's a little harder one, but anyways, you can borrow from your RSP as well. Okay, I hope that works for everybody. All right, now Valerie or LMD, I'm sorry, I'm going to work on your name because I'm terrible with names. Great with faces. Do we have any questions right now? Are we okay?
Any questions from the audience?
Mm-hmm.
At this point, you're welcome to, I don't know, Phil, would you like people to unmute themselves or put it in the chat?
If they put it in the chat and see if they got any questions right now, I think that'd be very, just in case we've got to something that they want to expand it out a little bit.
Sure. So if you have any questions, feel free
Yep.
to put them in the chat and Phil will get to them.
Thank you, Valerie. Thank you very much.
You're
Appreciate
welcome.
that. Okay. And now I'm gonna plot ahead here, okay? This is a lot of stuff. I know that the lending piece can be complicated. We're just trying to keep it simple. So, but it's regimented. It's also very segmented. So as we walk through this in terms of what the expectations and the types of loans, I'm hoping that we build the base for you, or continue to reiterate the base for you, that what you need in terms of understanding what the lenders are looking for and how to manage your own self, your process, and not get into a high risk situation. Now, understanding too that loans are just that. Loans are not a right, they're a privilege, and they're a privilege in terms of where we borrow from. They're allowing us to borrow their money. If we don't pay, of course, there's ramifications. They do have the right to get their money back, and if we don't, they have some options. Now, in Canada, they call it, are you in a seize or sue situation, which basically means that if you are lent money, I'll go back to the car, that's the easiest one. You lent money for a car and you cannot pay. The lender generally has the right to take the car back or leave the car with you and sue you for the balance. There are provinces though where they can do both. And guess what? Ontario is seize and sue. So if we can't pay our car loan back, they remember the word repo, right? If they can seize it, repossess it, or you can give it back. And you can, and what happens is that if you give it back, they'll take it, then they'll sell the car, they'll apply the money to what you owe. Normally speaking, there's not enough to pay off. There might be, depending, but normally there's not. And whatever's left over, they can, if you don't pay that, they can sue you for the difference, which is normally small claims court. So small claims court has got what, a $25,000 limit on it now. So it accommodates and incorporates most of these types of claims. So we do want to make sure we pay back because they can do both. I've made part of my career as I counsel on once in a while now, is to try to help people if they're going through any kind of a collection issue, because it can be a nasty bit of business. Now, while this particular presentation isn't about that, because we have a different one that goes through that, I can say this to you, that the process, they have limitations. Collectors have certain rights, absolutely, but we have rights too. Little things like they can't call before 7 o'clock in the morning, and they cannot call after 9 o'clock at night. I'm talking about the collection agencies. And they can call on Sundays between 1 and 5, but you can tell them not to. Anything you tell them to stop, you have to send it to them in writing, and they have to abide by it. Little things like that. So we do have some rights. But anyways, so just kind of bear that in mind. Put that in your hip pocket for now, okay? When we talk about anything unsecured, okay, remembering that secured or unsecured revolving credit, you can normally borrow up to a certain limit, okay? Now, these particular items, they are unsecured. They don't have also any, the ramifications on these, there's no security to pull back on these. They're simply, okay, you didn't pay, then they can take you to court if you don't pay and just sue you through small claims court, all right? Interest rates on these particular items, they will vary. As I told you, they can be as low as 2%, they can be as high as 30%. Remembering that when you get into a line of credit, it's a specified limit that says if you 10 grand, that's where you stop. Ideally, if you want to get like $10,000 because you need to do renovation in the bathroom, it's going to cost you 5 grand. You borrow the 5 grand, and you pay it down over time and get back down to zero again. Ultimately, that's what we like to do, but the line of credit offers a more superior rate. It's a little higher end product too, okay, which is kind of nice, and it can be very useful, especially when used properly. Credit cards is like the next level, okay? They're a little higher rate because generally they go between 10 and 30%. They're designed for the lower end purchases, the stuff that's not quite as expensive. They used to be able to get a loan at a bank for anything up to $1,000 at a certain limit or a rate attached to it. Now they don't offer that. You want a loan that small? Get a credit card. Okay, that's how they do that. You can get secured and unsecured. You probably unsecured the normal credit card. Secured is offered like a Capital One or Home Trust. You can, from a partial down to Home Trust will give you, say you want a $500 limit, they'll give you dollar for dollar. You say you give us $500, they'll hold it in an account in your name. It's just frozen. You just can't touch it, and they'll give you the credit card with that same limit. It operates like a credit card. A secured credit card reports to the credit bureau like a credit card because you're given a limit. You pay it down and up again, you can't go over. The difference, of course, with a secured credit card is if something ever happens and you can't pay it back, the lender has the full value of the debt. They can just say, okay, you can't pay, we get it. We'll just take the money that they're holding in the account, pay off the credit card, and close it down. And if it's only a small amount, they'll give you the difference, of course, okay? Excuse me. Now, normally credit cards, you want to make sure you choose the right one here. And I always say to fee or not to fee, that is the question. It's, do you want an annual fee or not? When you're getting a credit card, get it towards your personal finance personality. If you're a person that you're paying it off every month, then you're not getting charged any interest rate anyways, right? The credit card companies give you 21 to 25 days to pay off a new purchase. So that's basically one cycle. So if you're paying it off every month, the rate is irrelevant because you're not being charged anything anyways. What you want is say, okay, I can afford the interest rate doesn't bother me. I don't want any annual fee. That's the way it'll work. Okay, you want a higher rate? We'll give you zero fee per year. Okay, cool. Other way around, especially if you have a job where you have to front your own expenses and you might not get them back until after the credit card pay period's come and gone. You can make the minimum just to keep it up to date, of course. But if you tend to carry a balance, then the rate becomes important to you. Get the lowest rate that you can. It may have an annual fee attached to it, but that may not be a problem because that's the least the issues, right? A $50, $60, $70 a year fee is more than offset with the fact that you've got to carry a balance. So you want that lower rate. Okay. Make sure that you check the fine print and get the credit card that suits you because it does make a difference. And it does make a cost difference too, remembering. If you keep carrying a balance, we just did some math here for you. So this is just to show you in our face type of thing right now, that on a $5,000 card, even at 19.9, we're showing you is actually an inline and a fairly decent rate on a credit card, right? They're going to ask for 2%. That's the minimum payment a credit card company asks you for, 2% of the balance. So we do the math for you. We did it. If you had a credit card, ran up to $5,000 at 19.9, and you only paid the 2%, it'll take you 65 years to pay that off. Yeah, I know you could retire. Absolutely, you're right. And you're going to pay them 5 grand, over $22,000 in interest total. So what I hope this shows is that, yeah, we may have to borrow money. Absolutely. Do it wisely, borrow what you need, and don't just do the minimum. That's why we really encourage you, just keep one credit card, because if you're in a position where you got to pay more, it's not going to hurt you to pay a bit more. Your budget won't be impacted negatively. You can afford to do that, and you're going to pay it off in a lot less time, essentially in your lifetime sometime. Right? Now, And a couple of tidbits to that is we also I told you that they give you 21 to 25 days on a purchase, a new purchase. They won't charge any interest. If you take a cash advance, interest starts right away. Now, again, you may have to get one. We know that. But if you can help it, if you can avoid it, try to stay away from cash advances. They're a cost right up front. And remember, too, that if you're on a points program on a credit card, and as long as you're paying it up to date, everything is hunky-dory. But if you don't pay, you run the risk, if on a points card, that they may shut the program down on you, which can be devastating. So what's the point then, right? So just keep that in mind too, right? Somebody asked me alone, I should go back here and make one more point, that we talked about payments, and a question that come up, and I haven't heard it yet from anybody, that you say, if I have a credit card, if I'm supposed to wait until I get my bill and pay it, is that better for my credit? Have you heard that? Is that anybody been hearing that kind of chatter amongst, around the water cooler, or, with friends and that? If you have, let me put this to bed for you right now. I suggest that when you're making your payments, as you set your budget up, you set up to your pay, right? If you're paid every 2 weeks, maybe paying all your stuff every 2 weeks works best because it's more balanced, and you can do your credit card the same. Just make sure by the time it's due, it's all paid off. We've had people that have done that, broken it down, say, okay, they started paying right away. And they said, okay, $50 goes on mine, because they had very low balance on my MasterCard every pay. Good. Because it doesn't need to wait. You still get credit for it, because the credit card still reports that you borrowed some money. They still tell the credit bureau you've got a rate, and they have to tell when the last payment was. So you're still getting credit. You don't have to wait. Okay, I hope that helps. And if that's not clear, Valerie, anybody, let me know, and I'll make sure I really explain that, okay? Student loans, a bit of a different animal, everybody. They are one, of course, they're specifically, and they're handled by institutions, banks and the government. They're specifically for school expenses, books, tuition, accommodations, that type of thing while you're in school. We know that. The student loans you get through the federal and provincial governments, they're put on hold in terms of charging you interest until you leave school. Whether you graduate or you retire early from school, as it were, they'll give you 6 months to get on your feet and get going before they'll first of all charge you an interest rate, and they won't expect any payments for 6 months as well. Bear in mind too that a financial institution will offer student loans, but they're different. If it's through a bank, it's a loan through them. They're the ones that say, well, we need a cosigner. That's because it's an actual loan. It's not through the government. It's backed by the bank. So you're open to the same collection tactics and parameters that a bank would use on normal loans. Not the same as the government handling it. The government's a little bit more, should I use the word understanding? They have a little different set of rules. They don't collect quite as quickly as the banks do. If you've been asked to co-sign a loan, if you have a parent or somebody co-sign with you, in the eyes of a lender, okay, applicant, co-applicant are of the same level. Signer, co-signer, same level. I mean, you're both equally responsible for that debt. No one is more than the other. Of course, the applicant, like the co-signer, is in the background. For example, if you sign for one of your children and they, or a friend, and they make the payments, so they're the signer. But if you're the co and they don't make the payments, they'll come after you for the money. It shows on your credit report as well, and it doesn't matter. Separation. See, we're talking about the Bank Act here and the Collections Act, if you will. The Family Act is a different set of rules. So even if you're in a relationship that breaks down and there's legal ramifications, it doesn't really matter. Though the banks and the Bank Act doesn't recognize that. Like somebody may be assigned, well, you take over the credit card payments, but if they're not made and you're still a co-signer, you still got to pay them. Okay, just be forewarned. Consider yourself updated that once you're on. Okay, that's what it is. That's what that means, rather. Now, let's take a walk down as we walk through this little group of lenders. And I'm going to tell you, they're primary, secondary, and tertiary are the lenders. We're talking short-term or high-interest loans. You've heard them before. I've got a term that we use for these, but I won't use it. The buy now, pay later issues you hear, the situations. They're title loans, payday loans. It's an interesting group, and it's an interesting lending sector. And let's just take a minute to talk about that so that we're on the same page in terms of what these represent for us, okay? And the retail world will throw this at us. And furniture stores, bed stores, they're even financing pillows now, I think. Did they not? That's a good one. I don't want my pillow. I want to give it back. It's okay. I bled all over it, but you have it back again. All these things, they come under, we call the retail credit industry. It's the store fronts it. You sign the papers there, and it can be extremely convenient. Don't get me wrong, and there can be some good deals, absolutely. But you got to break down, what does it mean for you? Where can it make sense? Well, you can take advantage of when they say no payments now for 18 months, like no payments for 12 months. Well, make it work for you. And the way you do that is, if you get in a deal, and I love this, if you get a brand new dining room set, no payments for 18 months. Okay, what'd you borrow? So I borrowed $3,000. Well, guess what? For 18 months, if you pay $167, you're not charged any zero interest rate. At the end, it's paid off, and you've paid $3,000. I know, no brainer, Phil, right? Absolutely. If you take that, let's just stretch it outside the box for a second. You look at, all right, well, if I can't really do that right now, I need to go over 5 years. That's great. It's under $100 a month. Okay, you may have to get down that pathway. We get it. We understand that, maybe. But if you don't, good for you, because $3,000 becomes $58, just like that. Just like that. Okay. Now, you could also, let's look at a little alteration. Hit it in the middle someplace. If you can't go the 18 months, but 5 is too long, use your imagination. Be financially smart about it. What about cutting it off? 3.5 years. So you take 3.5 years to pay it off, about $140, just under. Now it's only $5,800 you paid. See, anytime you can take your payment situation and you can add to it, don't go to the max. It's to your benefit, because these things do cost money. And the retail credit area is one that does tend to make very good money. It does, because often what happens is, remember this, and if you do get involved with these situations, please earmark someplace on a calendar. If you're an Outlook, put the reminders in there. If you're an Outlook person, you're on your computer every day, you pardon the pun, you bank on that. Put the reminders in to revisit these. If you got a bet on finance for the next 12 months, to make the payments, or make sure you address it before the 12 months expires. Because if you just say, all right, I'll save the money, okay, you can do that. Save it for 12 months or 11 months in your own account, earn some interest, and then before it expires, and you got to make sure you go in before it expires, pay it off. You're 1 day late, interest goes on it, the whole bit, the whole match, okay? Now, we're talking about secondary lenders. This is the initial or the primary lenders are banks, our big five, right? Our federally regulated banks. Secondary lenders are things, a lot of places like City Financial, that type of thing, where they have a different understanding of the interest rate. They appeal to a different sector, and they will charge higher rates. Right? They're generally between 30%. It can be even more, 20 to 30%. They don't normally go beyond 5 years. And if you look at what that means to you, like what comes down to that, interest paid over 5 years, $9,400. Point is that secondary lenders, the City Financials of the world, those types of places, their rates are higher. Okay, and if you hear the word secondary lender, that's what they refer to. Okay, that tier. It's a little easier to get into the loan. It can be a little harder to get out, as you can see. That's all this particular screen is supposed to be showing right now. Now, title loans, we start talking about things like tertiary loans. Title loans, we don't see a lot of them necessarily advertised here in Canada. You may hear them more within the community being advertised, talked about. Bottom line is, if you hear it from a bank, it's more like a consolidation loan. They'll put a bunch of loans together for you, but they'll hold your car as collateral. It's more, title loans are more like an American statement, if you will, but that's what that basically means. Okay, and of course, it goes back to the rules. Even though you own the vehicle outright, you had to pledge it back because, I owe $50,000 in credit card debt. I got to get a better deal. To give you a better deal, but to hold your car, say, yeah, we'll hold that for collateral. Same rules apply. If you don't pay it, you're back into, they can seize and sue again. Okay. Tertiary just means third level lending. And this is the group that we really want to make sure that we have this, because we're right near the end of this now, and a quick discussion to this. Generally speaking, they're finance companies or payday lenders, and they, like paycheck groups, right? They generally give you a small loan. Normally it's unsecured. It just is based on your signature, and they tend to lend to your paycheck amount. If you get paid, for example, every 2 weeks and it's $1,000, they'll lend you the $1,000, less fees, of course. You'll probably walk out with about $800, $850 in your pocket. That's what they'll loan you after the fees. Yeah, they don't do any credit check, but the interest rates can be quite high. Okay? I don't know. I'm going to put a question out, and Valerie, if you just look at the chat. Now, everybody, we're just going to take a pause for a second, take a breath, take a drink. Do you know, everybody, what the highest rate in Canada is allowable to be charged according to the Bank Act? I'm just going to leave it. I'm not going to, no hints. What's the highest rate that any lender can charge us here in Canada? Okay, we'll just pause for a second. Just watch that, Valerie, if you would, for me. I just took a pause to have a sip of water, so I hope that everybody's doing the same thing, or your tea or your wine, whatever you've got in front of you right now.
We have 50 and 60% and 30% as well.
You got a 60 in there?
Yeah, a 50 as well.
How many people have replied so far? You got a good smattering?
So three people. Yeah, 3 people so far.
Good. All right. Well, we won't prolong it. I like that. Thank you. 60% is the right answer. 60% is in the Bank Act. It's a big number, and it's under review. It was not for us to make any decision on that here at this conversation, but it's a high amount. But that's the maximum allowable. And really, do we need to? That's up to the lender to decide whether they want to or not. But one group, like an Easy Financial, is a group that has different products they offer, and they make no bones about it too. Sometimes they will charge 40, 50, and 60%, depending on the applicant in front of them. Right. So if you're going to go to what we call these tertiary lenders, please remember that they do. I mean, you may have a need. I get it. You may have something happen right now that cannot wait, that you need to get quick funds for. Okay, we understand that. But please look very hard at getting out of it as quickly as you can. Because if you do here's the comparison right in front of us right now. We've taken the products and compared them for you. We talked about lines of credit. Yeah, lines of credit, credit cards, then bank overdraft are the big 3 from the banks, really, and they're stacked, lowest to highest. Payday loans, when you take into consideration that they're on the paper, their contract, I think they're only supposed to show 20% maximum. It's not the interest rate, it's the fees. And the fees, if you convert that into what really they're charging, it's about over 400% of interest rate being charged. And if anybody has been in this, I know you can probably, yeah, Phil, I know, we get it. And if there's any doubt, this is why they're so hard to get out of. Because quite frankly, you know what way it works. A payday loan pays loans to your pay. And when you get paid, after you take the loan out, you're expected, of course, to go pay it off, right? Because it gives you a 2-week interval, for example, because you told them you get paid every 2 weeks. Well, at the end of the 2 weeks, if you pay it off, what about the rest of life, right? You've got another 2 weeks with no money. So yeah, you can make a token payment on it, and they actually refinance the loan for you. They redo it. Hence, more fees. That's where it gets you. All right. So that's why we encourage people, be very careful with this product. If you do it one-off, you can get out, good for you. If you've been staggering with them, you've got a couple on the go. This is where we say, look, outside of this discussion right now, if you need extra assistance, please let us know. We'll do the counseling for free, and we'll help you move through this. Anyways, or anybody tell them, take a minute and breathe. Okay. Now, my final thought for you right now is that if you walk through, you say, all right, Phil, I get it. There's different types of loans out there, secured, unsecured. There's different tiers of rates. I get that, please. And I also know there's like 3 different types of lenders: primary, secondary, and tertiary. I get that bit. They have their parameters. At least now you can speak to it. If maybe you could before, continue to speak about it logically. There are certain things they look for, and certain things are just myths. They don't. And any questions in terms of myths, let me know now. We'll talk about it. But if you're in doubt, and we do this with all our clients that are trying to move on to the next level, and we get, for example, if you're in a renting situation right now and you're wanting to buy, and you're putting things in place. You're looking, you got this is a different presentation, of course, but you go, I got a down payment, I've got my financing in place. What we recommend is, or a car, just do a trial run. Look at what that payment would really be. Do it for 2, 3, 4, 5 months to see if that life flow is good for you. Is it work? Because if that budget works for you, you get used to it, then you're in a good place. Right? I had a very young fella come to me, and he was in a bit of, he thought he was in more trouble than he really was, but he wanted to buy a Mustang. And I get it, us young guys in our cars, right? We love our cars, but the payment was a little bit, but he wanted the car, right? And I said, look, if I could get you just cool your jets just for 2 months, right? And the upside was it was wintertime still. So you don't really want to take that car in the wintertime anyways. Here's what the payment would be. Do this until the spring. We had 3 months, I believe it was. If you can still make it work, and besides that, you get 3 months run, you get to save money for 3 months. But he was glad he did, because he stuck to it. He was able to get snapshot himself better at what he was capable of doing and whether that car worked for him or not. Was it too much car? That's how he did it. Okay. So there's a lot of stuff going on here. I want to take a breather right now and stop. And this where whether they're chat or unmute. Anybody have any questions? Anybody have anything that they want to express, they want to talk about right now that would be on your mind? You've got me right now. Let it out.
There is a question actually.
Okay.
So I freezed it. So it was about OSAP repayment.
Mm-hmm.
So I was asking about any general tips you might have for repaying like the student loans.
I'd say it depends on where you are in the repayment process. Are you just starting? Are you already in it? Are you near the end? Because no indication there of what it is, I guess, huh? Starting? Okay. Well, what I would just suggest is simply this, is that, first of all, when you're just starting to pay off, make sure if you're just getting started, it's not a bad idea to take advantage of that first 6 months that you don't have to pay. Okay, get some traction, first of all, because you won't know what you can pay until you get a couple pays under your belt. Right. Second thing is, in terms of repaying it, is contact the student loan center, because if there's no contact from you, and you're ready to pay, they'll just roll something out that kind of makes sense at their end. You may need a little extra consideration. You may need $30, $40 a month less, but you've got to phone and ask them. So my first tip is call them, please. If the payment amount's okay, if you can afford it and you go a little extra, this is a low interest bearing loan. It's nice to pay it off quickly. If you have anything else that's a little higher interest, pay it off first and then go after the student loan. Okay.
Okay.
So start with that. Does that help a little bit? Just get you all started off. Okay.
Yes.
Any variation, let me know. Okay.
Okay. Thank you so much. Any other questions from the audience? Okay, we do have one.
Okay.
Zadia, you can unmute.
Yes. Hi.
Hi there.
Everyone. I have a question. So for overdraft, if I have an overdraft with the bank, and I'll just tell you the scenario really quickly because I don't know how to ask a question.
Okay.
So basically, I closed the bank account that I had an overdraft with, but my overdraft was not moved to the new bank account. So they had asked me if they can do a credit check all over again just to transfer my overdraft. And I said, oh, no, don't touch my credit. Just let it sit there while I figure out what I want to do. My question is, the time that I let that amount sit in that account, did it affect my because eventually I just said, just close the account, plus the overdraft, I don't want it. Did it affect my credit? Does it, if the overdraft is sitting there and maybe because they charge bank monthly fees off of it, does that affect my credit for like around 3 months? Does that affect my credit score?
First reaction is it shouldn't. Now, where it hinges off is because when closing the account means that there's no more overdraft privileges on it. Now, so what happens is if it's an overdraft, and I'll just pick a number for you, okay? If it's $1,000, it just means you owe them $1,000. The product was overdraft. With the terms, clear it every 30 days. Once the account's closed, I would say, did they convert that into a small loan after that? Is it just sitting there? Because what it depends on is what terms did they keep in place? If it was make a $10 deposit every month, there'll be no effect to your credit whatsoever, none whatsoever. If they're holding it in, it can be, overdraft can tend to be like a limbo account. The reason why one of the institutions they don't want to keep it there all the time is because they need to move forward with how to report it. Now, is it past due? We're gonna make a small loan of it. So right now, off the top, just the way you said it to me, there shouldn't be any implications to it. Now, again, you know how to tell, of course, is if you're concerned about it, phone them and ask them, because that they'll just looking for you to make another deposit to clear that up eventually. But the way to do it is get a copy of your credit report and have a look at it to see how they're reporting it. First, if you could ask them straight up, don't worry, you're not triggering anything. They won't do anything in spite. No, it's business, right? They won't do anything in spite. They'll simply, you can ask them, how are you handling it? Is it still showing as overdraft? What are you expecting from me right now? Is it past due? If you can't get any satisfactory answers, that's when you can go get your own credit report. And if you don't know how to read it, it's okay. We can help you with that for free as well, by the way, okay? And then at least we can look at it together to see if it's showing on your credit report. And you can get it for free, or you get your credit report. You can also get one online, and you can pay, like, was it $18 or $16 or $18 if you don't need your credit score. So that's what I'm going to tell you. It's unfortunately, it's one of those, it depends on how they've got the thing notated right now. Okay.
Thank you.
Oh, you're welcome. I hope that helps a little bit. Let us know if you need more help with that, okay?
I will. Thanks.
You're welcome. Hopefully it's got no impact on that credit file.
Yeah, hopefully not. I had another question. Just when you were explaining that, I put it in the chat, but I figured I can ask.
Sure.
I have been able to easily access Equifax for credit report, but it hasn't been the case with TransUnion. Okay. How do we access TransUnion to get our credit reports?
How did you try online, or did you try writing to them with TransUnion?
I have called. They have a phone number. I've called the phone number. I've sent an email, but they don't get back to you. Well, I guess as quickly as Equifax, because Equifax gets I'm able to get a hold of them, or even just walk in.
Right. Yeah. Interesting, because at one time it was the other way around. Equifax is hard to get a hold of, but with TransUnion, what I recommend is getting the version online if you can. I don't like spending anybody's money, but if you've got access to $20 or so, if you can get online, that's the way to do it. I mean, the other way is, see, online also, they have a form you can fill in and mail it into them. If you're patient, you're okay with that, they will get it back to you via mail. But it's online is where the information is housed. So the form is there. Also, to buy access directly is online as well. It's one of the, when you're doing your own credit, it's good to look at it once a year anyways, everybody, okay? And it's a good idea to look at not just one or the other, both Equifax and TransUnion, because you want to see what's on there, right? And you want to make sure anybody looking at your file has your permission, things like that. So it's good to look at it once a year anyways. You don't necessarily have to get your credit score, but if you're curious, sure. The cost is about $30 per report. So $30 for Equifax and $30 for TransUnion. If you're okay with that, once a year, it's a fairly decent investment in yourself. I believe that anyways. Again, if you don't want that version, you have a free version too you can get. So that's how you help protect yourself too.
Cool, thank you.
Oh, you're welcome.
Any other questions from the audience?
There's some good questions. Those are good scenarios. We all run into that stuff too. Everybody bumps into it once in a while, and we know that.
I do have one question if no one else has one. I wanted to get your professional advice, Phil. So what happens if you're offered a line of credit? You don't necessarily need it, but a bank offers it to you.
All right. Well, it comes down, let's step by step. They offer it to you. Yeah, first of all, they're offering that you're saying it's okay to apply for it, or that they've already approved you for it. That's the first question.
Pre-approved.
Okay, you're
Pre-approved.
pre-approved. So what's happened is at this point in time, it's possible that they may have done a soft inquiry on your bureau. Because if it's your existing bank, for example, you may have already given them permission to look at your credit file once in a while anyways. But see, there's two hits, right? There's hard and soft. Soft hits don't hurt your credit score. They may do a soft hit and look at it and say, we've got approved for you right now. Nothing's going to happen until you accept it, right? It's just, it's there for you. That's all, right? So the choice comes down to whether you want it or not. And if you want it and you accept it, then it starts going in your credit file for you in reports. Really, that's about it. There's no other real implications in terms of being offered something. A pre-approval is just about how they got there. And as I said, generally, I think it's a internal marketing piece that has already a soft hit for you on your file. Any question to that? Do your credit, and again, I say ask them whether or not they did a credit file on you. How do you know? How do you get the approval? But there's no impact to you. Not yet. There's no impact until you start borrowing from it. Then you got to pay it back.
Okay. Thank you for that. That was helpful.
You're welcome. Glad to help if I can.
Any other questions? All right, I think we've taken up all the questions. If you have any more questions, just use the raise hand function or put it in the chat while Phil wraps up.
Yeah, so well, and you know what? Now that we're there, I just put up the money tips. It's kind of our last little screen. We have lots of resources, and of course, the ladies here, they know that they're our clients, and if they've got our contact information. So, if you need anything else, reach out to them, and they can certainly get you in the right direction. MyMoneyCoach.ca has got a plethora of information for you. Feel free to use it. It's there for you for your viewing pleasure. Okay. So everybody, I want to thank you for the time. I know it's been a kind of a long conversation. I wish we could do this in person. I really, really do. But thanks for staying in there. Ladies, at this point in time, I'm finished. I'm done.
Thank you, Phil. That was amazing.
You're welcome. My pleasure.
Thank you. Thank you. Thank you for taking the time to teach us information that we all need, that is very, very relevant to every single one of us and our loved ones. Thank you for volunteering your time as well.
Oh, you're welcome. And good point. It's for us and our loved ones. Excellent point. Thanks for putting that in there.
Yes, yes. Because even if they might not be here, we can always share the information with them.
Big time.
Well, right?
Absolutely. Yeah, yeah. We encourage that 100%.
Yes.
All right. Well, on that note, then, if there's nothing else, I'm going to wish you all a very good night. Take care. And ladies, you know where I am if you need me, right?
Yes, for sure.
Okay. Good night. Good night, and have a good weekend, all. Okay.
Bye.
Bye now.
Hey, thank you, Phil. Wonderful. All right, I'm going to share my screen again. There is something that we would love the audience to fill out. Here is a QR version, but L.E.A.D has also provided the link in the chat. L.E.A.D?
Yes. So this is the feedback form. I'll post the link again. We would really appreciate the feedback. It's about 30 seconds to a minute to fill out just before you log off. Thank you. And there's also a raffle at the end for there's a raffle at the end for the people that fill out the survey.
Thank you, Larry. So I will keep the feedback form up for another moment in case anyone else still wants to scan it before moving on to our next slide.
And yes, please follow us on our social media accounts, our Instagram, Twitter, and YouTube channel. So the past financial literacy workshops are on there on the YouTube channel if you wanted to catch up and learn more about it. Thank you once again for joining us.
Awesome. Thank you, everybody. We hope to see you at our coming events and catch this replay soon on YouTube.